call option. There's no difference, with the exception of the put, of the key for the put. Now, let's look at a couple of examples. We have an investor who buys a put option for insurance. The investor owns 1,000 shares of stock X, and he bought them at $55 a share. And he's got a strike price of $55, so he wants to protect it. Now he's going to get, in this case, he's going to pay $750. And that's, we've got 10 contracts, and he's going to pay 75 cents per share. So if he holds, if the stock rises to $57 and the option expires, he can sell the stock. He's going to get $5,700 from the sale of the stock minus the premium. So he's only taking, a $750 hit for the cost of the premium. Okay? If the stock drops to $50, the options are exercised at $55. So he's going to sell the stock at $55. From the sell of the stock at $55,000, subtract the premium, and you've now got $54,000, right? So you've reduced the loss. I mean, without the put, you would have had a bigger loss. That's the real point. Is that with the put options, you're going to minimize your loss. It's acting as protection against your loss. Against a larger loss. Okay. Now, as Marvin had indicated, options expire the third Friday of each month. And this is an options calendar that you can print these out online. And you see right here, I think you see the third, it's the third Friday of each month. You see the diamond symbol here. So this is just a good thing to know that, when you're trading options, you want to look at this to know where the options expire and how long you're going to be holding stock. So it's a good thing to keep on your desk.
Let's see, how do you get started? We talked about this a little bit, right? Most of you guys have your brokerage accounts, right? I would suggest that if you have a brokerage account, that you open up or you get an options trading contract open, right? Just so, even if you're not going to use it near term, call your broker, get an options contract, fill it out, turn it in, right? One tip when you're turning these things in. The brokerage companies typically don't want everyone with options accounts, right? Make sure when you look at the application, include all your years that you've been investing in your IRA, your 401k, right? Those years count as years of experience in the market, right? When you do that, it's easier to get them to approve the options contract associated with your account. And if you have an IRA, right, as I explained earlier, you definitely should have a options account with it. Open up the, you should have a self-directed IRA, basically, right, where you are able to select stocks that you want to hold inside under your IRA classification. And you couple that with the options contract so that you can do a couple of basic things. You want to be able to sell covered calls, right, which we talked about earlier, and also you want to be able to buy protected puts. And just another thing about this, you don't necessarily have to buy puts on the stock that you own, right? let's say if you have an IRA, you got 100 shares of GE, 100 shares of BP, 100 shares of Cisco and Apple and all of those. You can have all of those in that account. And then you can go to the SPY, right, which is the index fund for the entire market, and buy put contracts on that, so that if the market goes down, you have some hedge against the shares that you're holding in your IRA. I mean, those kind of things are possible. But certainly get an options trade to do an application, look it over, and couple that with your account. And it doesn't mean that you're going to use it next week or whatever. Just have it there so that once you get comfortable, if you decide you want to do something with it, you can.
Because during this period, as we showed you earlier, where the market is going to be relatively flat, covered calls are a good way to generate that income in your IRA. Okay. Now, what we've also listed here are some good books that you may want to take a look at. And now, if you just call either Fidelity or Charles Schwab, they have characteristics and risk of standardized options. They'll give it to you free. And it's a very good book that will go through and explain all the terminology and give you lots of examples. It doesn't cost you anything. But these are some very good books that I would recommend to take a look at.
This book, the Options as Strategic Investment, basically known as the Basic Options Bible. That's a book that I bought, I think, almost 15 years ago. And even to this day, right, when I'm thinking about doing something, if I have questions about maybe tax consequences, things of that sort, I can go to that book and find answers to questions. So it's very good. It's about that thick, right? Almost thick as some of the Bibles, but it has a lot of good information.
This guide to money and investing by Standard & Poor's is really a very good tutorial on the whole financial market. How banks work, how bonds work, how options work, how stocks work. And I think it's only like $18 a month. But it's a very, very good book that gives you a broad overview on the whole financial institution. Okay? And now these are some very good websites also that let's see. Ahead of the curve, this gives you, if you listen to CNBC and you come out and they come out with all these financial reports, this is a very good tutorial on what all those things mean and what's their impact on the market. Bloomberg is another good one. They have a lot of inclusive stuff. CBOE, I think we'll get a chance to see that. Stock Traders Almanac. As you can see from that big picture chart, there's patterns in the stock market. Stocks have seasonality charts, we call it, where in most they tend to, when I say seasonality, is that stocks will either tend to be up, this time period, say in October, or then they might be, down in, say, March or something. But there's a seasonal period to where stocks really outperform. And this is something you also want to be aware of. And this is free. freestockchart.com is a very good website for real-time free data. Now, I included one example of what I use every day as part of my trading plan. This is not, to say for options, but I use it for stocks. But if you buy options, you certainly want to understand, where that stock is, because your options are going to vary with the price of that stock. Now, as part of my plan, I want to know